bond markets got off to a bit of a rough start in 2022 as investors began to prepare for the Federal Reserve to raise short-term interest rates. While the quarter-to-quarter or even year-to-year movement in interest rates doesn't have to mean much for investors that expect to hold their bonds to maturity, day-to-day fluctuations in yields do impact daily bond pricing. An easy way to think about this is to remember that bond yields move in the opposite direction of bond prices. Higher rates or yields mean lower bond prices. So the bond market anticipating higher rates or the Federal Reserve raising interest rates should be expected to have a negative impact on bond prices and hence short-term bond returns. With that in mind, this chart paints a pretty clear picture of why bond returns were negative this past quarter. It shows what the collective bond market anticipated in terms of the number of times the Fed was expected to raise short-term borrowing rates by 0.25% over the following 12 months. Entering 2022, expectations were for just 2 rate hikes. In January and early February, that jumped to 7, and by quarter end, that figure had jumped to nearly 10. There is general agreement that the reason for this jump is because inflationary pressures aren't going away anytime soon. The basic concept behind the Fed's use of rate increases to fight inflation is that by making money or credit more expensive, the Fed can slow consumer demand in the overall economy, which should help alleviate some of the inflationary pressures. It will be interesting to see how effective this is, given that many of the inflationary pressures we're experiencing today are more supply-related than demand-related. As one of our asset managers noted, the Fed appears to be trying to steer a big boat through violent rapids, armed only with a small paddle. Meaning that despite their best intentions, the reality is there are powerful forces today that are outside of their control. That same manager also pointed out that the Fed actions over the years have increasingly had a greater and faster impact on stocks and bonds than they've had on the actual economy and inflation. This last quarter's bond market return of negative 5.9% is evidence of that. Inflation continues to run hot, yet bonds had their worst quarter in 42 years. So what's the good news for bond investors? While we're far from overly optimistic on bonds, it's also possible that the worst may be over, at least in the near term. Market expectations for what the Fed is likely to do this year are now pretty aggressive. And while they may be determined to fight inflation, they also know that by going too hard, too fast, they risk causing a recession. I hope you'll stay with me as we turn our attention next to the Russia-Ukraine conflict and some of the possible economic and market fallout from what is occurring there.